Good afternoon and welcome to FBN Charting Points, a technical look at ag markets. Today is December 25th and it is Tuesday. All right, trading futures and options involves the risk of loss. Please consider carefully whether futures or options are appropriate to your financial situation. The material is provided as is and for informational purposes only, and it is not intended to be a substitute for specific financial, trading, legal, or tax advice. Neither Farmers Business Network nor any of its affiliates make any representations or warranties express or implied as to the accuracy or completeness of the statements or any information contained in the material, and any liability is therefore expressly disclaimed. Past results are not necessarily indicative of future results. All right, we're going to have a bit of a fundamental slant to this presentation today. I know it's called Charting Points, a technical look, but I think sometimes technicals can help to understand, or fundamentals can help to understand the technicals, and they are both important, as we know. So first of all, we're going to get into the Statistics Canada report and just some thoughts I had on what was released in today's or in yesterday's release. As we know, all wheat in Canada came in 850,000 tons above the average trade estimate. That is a 2.1 million ton change from August. Spring wheat was 760,000 tons of that as well, and also a 2.1 change from August. So we are in a situation where we're kind of understanding that the crop was bigger. And I'll show you some charts here because it does kind of make sense when we look at it from a year over year standpoint, because a lot of these production numbers are lower than last year, but they're up significantly from the drought year. So, I think that there was a lot of sentiment this year in Canada around comparison to the 2021 drought. And it's more so a year on its own. It didn't really track towards any particular analog year as far as weather to production to yield. And we'll show you some of that. There's a couple of things that are concerning here. Of course, the 300,000 extra or 1.1 million extra tons of barley that was put onto the S&D. There was 1 million tons of canola put onto the S&D as well, although that was largely expected. So the market was expecting 18.3, and the market came in at 18.328, so very close to expectations. Pretty much everything else was in line with expectations as well. So not a lot of surprises here. So nothing to really make the market change a whole lot. I'm going to get into the charts on some of these because there has been some changes over the last couple of days. Unfortunately, I don't think that they're related to, or fortunately or unfortunately, depending the way you look at it, they're not related necessarily to the Statistics Canada numbers. But I think what the Statistics Canada numbers do is it gives us a good springboard point. I think Stats Canada did a good job this time of making the adjustments that were needed. We may still see, a few 100,000 tons adjusted here or there. Generally speaking, on the grain side, Statistics Canada gets this more right than on the oilseed side. So canola probably is still at risk of adding, I would say, another 500,000 tons or so to the production number. That's just a statistical, historical average of how much they add every year from the September to the final. But so there's probably still something to be gained there. But I think the wheats and the barley and those types of things, we may have seen the big revisions now, and we can just move forward. I'll start talking about our canola S&D a little bit here. So here's the production number, 18.3. So as you can see, that the average yield across the country was 36.9. That is 28.4 is where the 2021 drought was. So as you can see, this kind of kicks off that sentiment, or that kind of the whole year. How it works is that in 2022, Canada recovered from the drought. This year, the weather knocked it back down a little bit. So we're still not seeing yields that are anywhere near, the 1920 area. But the 36.9 is still pretty low, but it was a significant improvement over last month. So unfortunately, my confidence level, I would say, on the crush and exports in canola is probably the strongest part of the S&D that we had going into this. 10.5 million tons of crush is a lot. It We're barely on track to reach that right now based on current crush pace. Exports are running very low, and as a result, this is the only number that we can put into that crush export. So what that does, though, is it kind of brings our ending stock. So we've left kind of the bottom half of the S&D, the demand side of the S&D alone here so far. So that production increase kind of got added right to ending stocks. Now, as you can see, we kind of have this, if we kind of average these, we're looking at probably somewhere in the 1.5 million ton range in the last few years. And so as we move towards this year, and the number spits out at 1.5, 1.6, it does make a lot of sense. I think the market will gravitate to that number. So I think that our ending stocks are probably going to be somewhere around 1.5. If there is something that jiggles around inside the S&D, if we add another 500,000 tons to production, for example, I think what that means is we will end up exporting that extra 500,000 tons. So I think if anything, we probably have some opportunity to increase exports to 7.9 if that supply is available. I do think that, we probably are going to end the year at about 1.5, 1.6 million metric ton of ending stocks. And what that probably means is that these demand numbers will just adjust to follow through on that. So just to give you some idea of what the charts look like now, again, we've kind of seen this constant decline in canola production here. So if we kind of even take out 2021, the decline is happening. This is not what needs to happen in a environment where we are adding 2 million or more tons of crush capacity in the next, call it 12 months or so. So going forward, I think that if this trend continues, we could see really tight canola supplies, although we still could strip a significant amount of demand out of exports and put it into crush. So I think there will be a balance there. But the market is obviously telling us it wants more canola. It wants to crush more canola. There's more canola even after the next 12 months. Canola crush that is slated to go in. I think a lot of that depends on finances, however. Interest rates and building supply costs and things like that are kind of putting a hamper on some of that. But this is the trends anyways, that we have a declining trend in canola production, but we have an increasing trend in crush. So right now what that means is that any extra crush that gets added to the books has to be taken out to exports. At this point, that's not a big deal because there isn't a whole lot of export demand. But if we ever get to a year where we get into a crunch where, Europe or Australia or both of those continents receive, a drought or something like that, then we could see the price or the demand rationing need to happen at a much faster pace. So, not that I can foresee any weather hiccups in the, across the ocean in the next, year or two, but that's a potential. And I'm just looking at trends here. This is what that yield looks like from a charting standpoint. So as you can see, the last 10 or so years, we've probably got average somewhere close to 40 bushels an acre in this period leading into 2020. 2021, 2022, and 2023 have really hammered that down. So there has been some risk put into yield. It's not just an acreage story that we're seeing some of those declines in. And this year, of course, was a decline over last year. So, big yields, growing yields seems to have, we kind of have a law of diminishing returns now where the early, in the 90s and early 2000s, we saw some pretty rapid expansion of yield. That may have come to a head, and now we're seeing a lot of weather influences as well. Here's what the supply number looks like. So supply is still a little bit constricted after 2021. We haven't climbed back out of that hole yet. So again, these are Statistics Canada numbers. We're at 19.9, just shy of last year's 20.1. So supply is actually quite similar, even though production is down year over year. For all intents and purposes, we're talking about 20 million tons plus or minus 2. So, supply looks very similar to last year. So I don't think that this canola market is at risk of absolutely collapsing. And what I mean by that is, we used to see canola prices in the 400s. Do I think that's a possibility? No. Do I still think that there's potential risk as the year goes on, as the demand story ebbs and flows in this market? Yes, I do. And the chart is showing some of that as well right now. Actually, I'll show you that chart right now. So this is ICE canola for January. We broke below a technical support level today. It traded down to 665. You know, this does look bearish now as we move. You know, if we just look at January in isolation, you know, the next real support that we have is down here at 620. So that potentially puts in another, you know, dollar a bushel or $44 a ton of risk into this market. So that is something to be aware of. If you're looking to spin it a little bit more bullish, or maybe the word is less bearish, you can look at the continuous contract. And I think that this is important because it factors in, you know, the lows of November. So the previous contract was just factoring in the lows of January, but now we're talking about the lows of November. So, you know, carry in the market is a funny thing. It doesn't always seem to be, it doesn't happen immediately, but what might be happening is we're seeing it now, where the lows in November or even, you know, October and November of the November contract, the market price is moving down to that. So we haven't made a new low yet on the monthly continuous contract, and I think that might be important. So that might mean that we find some support somewhere near 640. You know, we have this this 620 area that we were talking about before is, you know, those lows came in June. So this is June here. June 30th, I think, was the lows that we saw on the continuous contract. So we haven't broken short-term support yet on the monthly. I think we are moving potentially down to that area around the 640 area. So we may see support there based on the monthly chart. The January is just kind of converging down to where the lows were of the November, which is not an abnormal thing to have happen in a market that is showing some carry in the market. So if you want to hang on to the 640 support, great. I think if you're positioned where our recommendations are at 60%, you probably have the ability to do that. But there is an outsized amount of risk down to those previous lows in June if you're you know, kind of below where you might want to be at this time of year for sales recommendations. Let's move on to the wheat S&D now. Again, this is now when we put the new production numbers in for wheat. We're 27,909. This is wheat excluding durum. So this does include Ontario winter wheat as well. But this is kind of the S&D that the market looks at when it strips out durum. So it is important to look at this. We didn't really change. I did actually change a little bit on the export side of this S&D. Now you'll notice here, and I'm going to kind of focus on this a little bit. I have 1 million tons less exports here for wheat from this year than last year, which is interesting because the supply is lower, so that helps explain that. But what's interesting is that our export pace to date is exceeding last year, and so I do want to put a spotlight on that. But we'll get through kind of these fundamentals here in a second. This is what that looks like for in a chart form. So we're not dealing with a small crop of wheat here. 27.9 is still a healthy size crop. You know, it's lower than the last couple of years, but, you know, higher than 19. And as you can see, we kind of we're tracking higher over time. And then it took a setback in 2021, but, you know, we're still tracking higher than we were 19, 18, 17. So even in this last 10 years, this is the third largest crop in the last 10 years. And it is, you know, closer to the highs than it is towards the lows. So this is not a small wheat crop in Canada either. And I think it is, kind of worth noting that. Here's what the yield chart looks like for that as well. 50 bushels per acre was the average for Canadian non-durum wheat, which is a pretty benign number at this point, but definitely lower than the average for the last 10 years. Total supplies on farm. So now we're getting into where things look a little bit crunchier or a little bit shorter in supply. That 2021 crop, we're still dealing with the effects of that and the low carryout that happened as a result of that 2021 drought crop. That pushes supplies. You know, even though production is third largest this year, you know, we have a number of years where we saw supply at a higher rate in the last 10 years, more often than not, actually. So even last year, we had supplies that were higher than we have this year. So there is still a little bit of a crunch on supply in the wheat market. This is particularly interesting as well when you just kind of strip spring wheat production out. So now this is just prairie spring wheat production. Alberta, Saskatchewan, and Manitoba combined 24.3 million tons versus last year's 25.3. So a million tons less of spring wheat in this crop year. Again, we're far exceeding that of the 2021 crop. But again, we're kind of pushing towards for sure below kind of 5-year averages if you take 2021 crop out. So it is a bit of a tighter supply on the spring wheat side. Here's what the yield chart looks like for spring wheat again. A considerable yield hit, and if 2021 hadn't happened, this would have looked a lot scarier, a lot tighter than it does now. Here's also a chart of Manitoba, Alberta, Saskatchewan. So actually, Manitoba here from 21 has continued to grow production in spring wheat overall. Saskatchewan did as well. It's really Alberta that took the hit this year and lowered the production overall as a result of some of the dry conditions. So we saw an increase in production in Saskatchewan, an increase in production in Manitoba, but Alberta got hit a little bit harder, according to Stats Canada. So now we're going to get into the export talk here. So, this chart shows a plus minus versus last year of wheat exports in versus last year. So currently, and you can see this ebbs and flows a lot because some weeks have good exports, some weeks have weaker exports, and it all depends on what the week previous was. The current statistic right now, this one right here, means that we have exported 500,000 tons of wheat more than we had at last year at this time. So, if you go back to my S&D, we're estimating that wheat exports are going to be 1 million tons lower this year than last year. But I can only in order to make my S&D balance, I can only, put in that many exports. So there's a problem here. We have something's wrong. So one of the things there's a couple of things that could explain this. One is that there is still more production available to the market than what Stats Canada even reported this week. So that is an opportunity. That's a potential number one, is that we're still understating the wheat size of the wheat crop, and that more will be added. That would be a rarer occurrence. The other explanation is that we've done more exports on the front end, and that it will fall as we go towards the back end of the crop year. If that happens naturally because demand dries up, there may not be a reaction to the market. But if it happens because farmers start running out of product, or the supply gets more scarce, particularly in the farm bins, then I think there's an opportunity for prices to rise because demand needs to be rationed. So in some way, demand needs to be rationed. We don't know yet if that's already worked into the market, i.e. the demand for the back half of the crop year already looks weak and is expected to stay weak, or if when the demand comes to the market, if we price ourselves out of the market. Either way, that means that some demand rationing needs to occur in order to, essentially to get to our target now for exports. We need to strip not only the million out that we had called for at the beginning of the year, but another 500,000 of overperformance that we've seen already. So there may be some demand rationing coming into the wheat market in Canada. That may help to bolster prices. I think that will likely play out in the basis market more so than futures market, but depending on how deep it is, it could have an impact on the futures market as well. So that's kind of the thesis going forward, is I think that wheat could continue to look strong, particularly if canola exports continues to look weak, because the elevator companies need to compete on something. And so far this crop year, getting towards the Christmas time here now, the path of least resistance has been to export wheat. So I think this is a bit of a positive story. The only thing that would knock the teeth out of this would be if Stats Canada is still under reporting production. Historically, that wouldn't be the case, but it is possible. Here's just that export chart as a cumulative, and as you can see, we are tracking closer to last year's performance in exports than we are this year's. And of course, we're calling for, 1 million or so less tons to be exported this year. So something's got to give. Either my S&D, actually, here's the next slide here. Either my S&D is wrong, and we're not going to carry out 3 million tons. We're going to carry out significantly less. That would allow us to add another million, potentially 1 million tons or so to match last year's. Or that demand has to ration itself, and the way to do that is to jack up prices, and that may be the path of least resistance. As you can tell in the last few years, 3 million tons of carryout or ending stocks is very low in this market. So even pushing it down to 2, that would be very rare, and it would probably be the lowest we've seen in a long time. And I don't think we're going to get there. I think we're going to carry out somewhere around 3 million tons, and I think that may mean that we have to ration some exports out of the market based on our current export pace. Again, assuming that Stats Canada now has this production number at 27.9 correct. Here's what the chart looks like on Minneapolis. So I do think that there is potentially we should participate in this market as we move towards this resistance here. This is about 750 on the March. If we can march towards there, and I don't know if it's even worth being cute right now between 740 and 750 to do that. So there may be a sales recommendation forthcoming very soon in Minneapolis wheat, just to take advantage of this rally that comes up to match kind of a double top year previous resistance. So don't want to let that go to waste. I don't even think this dime that we're seeing below that level is worth gambling on at this point. So you can expect a sales recommendation from us shortly on wheat. I think it did close today in a good form. We made a new high. We made a higher low on the daily chart. You can see this is just kind of marching higher. There's some positive stuff to talk about in the wheat market. I didn't put Chicago and Kansas charts in here because I didn't want this video to be too long. But one of the major stories that's playing out right now is that there's demand coming in for particularly SRW and HRW wheat into the U.S. from China. That's helped to rally the markets, and these markets are positioned very short. Right, we have a near record short in Chicago. We have a record short in hard red winter, or a near record short in hard red winter, and a record short in hard red spring. So these markets are ripe for a short covering rally. We may be seeing that now. We're seeing a little bit of that happen right now. Whether or not it'll push past those previous highs is yet to be seen. But this is helping the market this week as opposed to hurting it like it did the week prior. All right, quickly just through some soybeans here. Soybeans did make a new low yesterday and pushed back to a new low today. Although, as you can see by where all these closes are, they've been very tight around the $13 mark. So that seems to be a bit of a, even though there was a push lower, maybe there's some stops that got flushed out down to $12.90. The market quickly recovered back to 13. It closed above 13 today. There may be some support building at 13. But this market does look pretty dangerous. It looks like it does have the ability to go and test the 1270 support area as well. So just be mindful of that as we go forward. There's a lot of things at play in the soybean market. One is meal. Meal has peeled off considerably. It is kind of getting into this area where I think we talked about this last week, just kind of testing the 61.8% Fibonacci area. It's weak as well. We are seeing, some rains in Brazil. This is a map of Brazil with the soybean area overlaid onto it. This is Mato Grosso. This is where everybody's talking about right now. About 26-27% of the soybeans are growing right here. As you can see, the next 5 days are pretty. There's some rain in there, but not a lot. Mato Grosso del Sol down here and this area of Guayas have received a lot more rain in the last little while. But the forecasts are. They aren't really adding support to the market anymore. They're probably adding more pressure than anything. If we go out into the next 5 days, so this would be into the next 10 days, we start to see, that we're getting 1.5 inches, 1.75 inches, in some areas 2 inches of rain in a lot of these soybean growing areas in Mato Grosso. So is the market trading a 10-day forecast? with a bearish tilt to it. It's possible that they are, but I think there are some other things as far as the meal goes, and some of those factors as well. All right, so that brings us to the end of Charting Points today. Thank you for joining us. We will see you again on Thursday. Have a great day, and we will see you again next time.